Quick show of hands. Who is hoping to make a lot of money in their careers? Okay, so we're all in the right place. Okay, thank you very much for being here. We're going to start with at the high level, because everything actually starts with fixed income. It all starts with the 10-year bond. We talk about the US 10-year bond. What can the US government borrow? What's its cost? But around the world, the 10-year happens to be a really important number for financing. And you know David Swensen, who was at Yale, one of the great managers. He wrote a really important book for any of you thinking about money management, which is Pioneering Portfolio Management. He said, you want to be an investor in an inflation-prone world. You don't want to be a lender. And we're going to talk about inflation as we go on. 200 years of history of interest rates in the US, synthesized back to 1792. I think it might be courtesy of Goldman Sachs. But you can see the sort of the peaks and the troughs, and you can see the anomaly, which is when I started in the business, or actually maybe a little bit later, is rates were really, really high. You used to be able to buy a US government bond, 10-year maturity, by 15% coupon. I mean, why would you ever own anything else, given that, as we're going to talk about, long-term equity returns are much lower than that. But I guess the point I want to make about this is that you've all studied, or you all know enough about economics, that when there's an inflationary problem, as we've seen in the last 24 months, central banks push up rates. And they're pushing up rates, they squeeze the economic life out of, if not out of the system, but they squeeze it enough to start to restrain demand, to slow capex, slow consumption, and down we go. But central banks know, whatever their mandate is, and most of their mandate is around price stability, that if you push up rates, you squeeze, you don't want to let this last for too long. So you get sharp spikes of trying to squeeze out inflation, and then you'll get much more drawn out bottoms, which is what we've been going through as central banks, I think very irresponsibly, refuse to raise rates in a timely manner and left themselves with a more serious predicament. We actually got a chart here, rather extraordinary, that goes back all the way to 1310. Bank of England published this, and you could say, well, the trajectory of rates has been down, but since that's from 1804, you can see you've had interventions where interest rates have rallied very sharply and squeezed all sorts of parts of the business. And where interest rates go, equity markets must take note, because two things drive equity markets over the long term: earnings and rates. And if you can get 7, 8, 9, 10% in a safe government bond, you would probably go for your own asset allocation. Well, I might have more bonds and fewer equities. And I said earlier on about who wants to make money. However much you make or don't make, and whatever your career trajectories, you are going to be thinking about either your families or your pension in due course, about how you allocate some of your cash flows, whether you're in bonds, whether you're in stocks, which currencies you're going to be in, whether you're going to look at private equity, whether, and hopefully not, you'll be in crypto. We might come back to that. And so so being financially literate is unbelievably important, and we don't do it very well in this country. We don't understand risk very well, which is why more people in the UK have crypto accounts than they do equity accounts, unbelievably. And we need to teach people, about risk. And here you are, Oxford, you're in a great place of learning, but learning about practical investment experience is important. So 74% of years have had positive returns over, I think the data is 100 years. So it's proper long-term data. Always beware. Yeah, it was 1926 to 2017, so it's near enough. Good quality data. When somebody says, oh, look at this, what's happened over the last 10 years? Like, beware, because 10 years isn't the proper time frame to analyse things. But the really painful bear markets, and here you can see the distribution, and only really 1 year was down 40 to 50, and then we've had 2008 down 30 to 40. We'll talk a little bit about how you deal with the pain as that happens. But the worst bear markets occur when there is a recession. Now, here's a long-term chart. We show it on a log scale for obvious reasons, that we want to be able to show the moves proportionately. Big swings. And if you knew nothing, you'd go, well, from 1997, of course I'll own equities. It is the obvious thing. And here we are. Here's the data. Since 1900, equities have returned nominally, so before you take into account inflation, 9.5%. That's 6.5% real. And US bonds, 4.8% nominal, and real 1.7%, and bills just short-dated cash. But there have been periods, I don't show it in here, there have been periods in here, including a 25-year period in the 1970s, where in real terms, you made no money owning equities. And inflation, remember, is the enemy, because it's your enemy as an investor, because it's your purchasing power. So when you get these big drops, such as the Great Financial Crisis, market drops 57% over 7 months. You've learned equities over time give you superior returns. Fantastic. Until you hit a period like this, and your stomach is lurching, and you're suddenly losing money, and these are your hard-earned savings, and it's hard. You're going to stay the course. And one of the problems about us is we're human, and therefore we're frail, and therefore we move between the poles of greed and fear. Here's a 20-year sample of returns. Now, it so happens that over that period, gold returned more than stocks. Over time, we'll talk about that, 7.2%. And yet the average investor in that period earned 2.11. Why do you think the average investor earns such a low return relative to the headline equity indices? The problem is we get scared out of stocks. We hear biotech is all the rage and it feels really hot and we've got to own Amgen and we've got to own British biotech and whatever it might be. And then things look hairy and scary and then we sell. It's called getting the monkey off your back, and it's the biggest problem in the investment business. And the other problem is reading the press. So here's just one example of many. The world's most admired companies for a long time was the American company General Electric. And we all know General Electric, power systems, aircraft engines. Here was the article. This was Business Week. I mean, a proper magazine, serious journalists. Out comes the article. Stock goes down 85%. Okay? Because have a little look at that quotation from Stan Druckenmiller, who worked with George Soros. Never invest in the present. Think a year plus from now. If you invest in the present, you'll get run over. Now, there are times where you could have said that about Apple 3 years ago, and you'd be going, well, that is not true. But who knows about Apple today? I don't have a strong view. Apple's a fantastic company. Sony was a brilliant company. But the stock market is a discounting mechanism. And if anybody is really interested in financial history, this is the FT30, which was the predecessor in the UK of the FTSE 100. Look at it. Second World War breaks out. Here we go. Down here in June 1940, Hitler had just invaded Paris. It could not have looked more bleak. The market starts to bottom. Now, the US hadn't joined the Allies. There was all sorts of uncertainty. It was extraordinary, but markets were beginning to see something or sense something, and the bearishness wasn't overwhelming. And of course, if you had, and I don't have it, the German stock market at that time, that got wiped out. So here's a question that I'd just like to ask you, which is, which company in 1988 had 145,000 employees, 65% market share, revenues of 16 billion, had existed since 1880, and was probably the most admired consumer product company in the world? Any takers? Coca-Cola. Coca-Cola is still going strong. No. No, people are still smoking, and they own snus, and they own vaping, and they own the cannabis companies, so no, they're still going very strong as well. It is American. Kodak. So this gentleman said Kodak. What are you studying? MBA. You're studying your MBA. Well done for you. Eastman Kodak. Some of you go, who's Eastman Kodak? Never even heard of it. I mean, it does exist in a reformed company. Eastman Kodak dominated photography. If you wanted to take a photograph, you had a roll of film in your camera, and Polaroid had a small market share. Kodak dominated the market. You had to send your film to either Boots or the chemist or somebody, and they would process it. So the point is that great companies fine today, and they can be great, but for a lot of times, those great companies lose their edge. And here's the Japanese market. Japan, the Nikkei peaks here in 1989. It was over 45%, nearly 50% of the world stock markets. Japan could do no wrong. It had emerged from the Second World War crushed. It doesn't have any natural resources. It starts making plastic toys, and then it graduates to cars, and the next thing it's dominating, printers and cartridges and photography equipment and electronics, and it is introducing lots of stuff that it can't make any longer because Vietnam can make it more cheaply. But this is a secular bear market, a cyclical bear market. Defined by a market that declines 20% or so, is a garden variety bear market. Uncomfortable. A secular bear market wipes out your capital. Now the valuations there were absurd. So to give you an example of that, in the top 1,000 companies in 1989, the top 7 were all Japanese. And of them, I think 5 were Japanese banks. I mean, it's just unimaginable. 10 years later, there were none in the top 10. So one has to be very careful about, the obvious, that George Soros had this expression of discount the obvious and expect the unexpected. And if you'd own Amazon, and we all know what a great company it is, it went down 95% in the internet crash. 95%. And it wasn't clear that Amazon, which was selling books, and books only at that stage, Amazon wasn't ubiquitous, Amazon wasn't sort of dropping packages off. It was a potentially interesting business, along with AOL, that most of you will think, well, I don't know about AOL. AOL was really one of the first players in the internet. And just because we had Michael Milken as a guest on the podcast the other day, he financed the mobile telephony business back in the late 70s, and AT&T had worked out the technology for a mobile phone. They went to McKinsey. Anybody think you're joining McKinsey here? Want to join McKinsey? No. They asked McKinsey to do a study on mobile phones, and McKinsey came back and said there will be no more than 1 million people using mobile phones at any point in time. Okay, which of course wasn't very good advice. So stick to investing, not consulting. So let's just pivot. Foreign exchange, gold, oil, and uranium. We think about investing, but we've got an asset we have to think about, a bond, a stock, and then what currency? I can just look around the room, and many of you will have very different reference currencies. The reference currencies, how do you think? Ultimately, where's the bulk of your income? Where's the bulk of your expenditures? If you're sitting in the UK, well, that's easy, but, many of you might be working in all quarters of the world and have very different liabilities, and assets. And the question that is being talked about in all sorts of circles is de-dollarization. As in, the dollar has ruled supreme. It isn't the world's reserve currency, although people talk about it, because de facto. So it was Giscard d'Estaing, the French president, who said, the US had an exorbitant privilege, because effectively it's been able to borrow more cheaply than other countries because the dollar is their currency of choice. And this is actually a JP Morgan slide. And what you can see in a number of points here is that, one, the dollar still dominates, and here we are, 75% essentially of foreign exchange turnover is the dollar. And in reserves, it's creeping down. And you would expect that as other countries, emerge. But, China's renminbi is not convertible, so it's not in there. And the euro, although it's a workable currency, hasn't achieved the level of reserve diversification, people thought. Although, post the Ukraine invasion, the US's policy of seizing Russian reserves, does raise questions about, how some of what is now termed the global south may think about the dollar and dollar reserves. Now, we all think about currencies having some volatility, but just to put it in perspective, during the Asian meltdown in 1998, here we've got two currencies here, good countries, Korea, a fantastic country in terms of its brilliance at so many levels, and this was the Malaysian ringgit. These currencies go down 70 and 80%. Now, that makes sense sometimes in a place, as we're going to talk about in South America and later on, but really these things went from being, and the reason that happened is that they borrowed a large amount out of their own base currency. So when you had the collapse of their currencies, their debt levels became ever more unsupportable. But they came through that, and if you bought those currencies, you did very well. Now I want to show you two slides here, and I don't know, this is a history lesson, because back in 1992, sterling had joined the exchange rate mechanism. So that was what was going to become the euro. Margaret Thatcher was deeply opposed to it. Her Chancellor said this was a good thing, because what was the UK's problem? Historic inflation. So try and become part of the club, and the disciplines of a Bundesbank that had been rigorous over so many decades, ever since the hyperinflation of the 1930s. So they joined. Now, we'll cut to the chase, which is that essentially the UK was struggling more and more with these higher rates. And one of the reasons they higher rates was that Germany had merged East Germany and West Germany, and the Ostmark was transferred into the Deutschmark at a rate that made no economic sense. It made political sense, but it didn't make the economic sense. So there was an opportunity. Now, we're all familiar with what hedge funds do, but in those days there weren't so many hedge funds, and there certainly weren't any hedge funds that were as successful as George Soros. So George Soros had as his right-hand man a chap called Stan Druckenmiller. Some of you may have known, I had a quote from him earlier on. We were lucky enough to have Scott Besant on the Money Maze podcast, who was working there. He was George Soros' CIO. Very, very smart man. Anyway, so it so happens that somebody managed to get me a speech that this is the speech that Stan Druckenmiller typed up, made. And I just want to tell you what happens here, because it is unusual. He said, it just so happens, this is Stan, he said, it just so happens that Soros was in the office. He's usually in Eastern Europe. So I go in at 4 o'clock and I said, George, I'm going to sell $5.5 billion worth of British pounds tonight and buy Deutschmarks. Here's why I'm going to do it. And it means that we'll have 100% of the fund in this trade. And as I'm talking, he starts wincing. Like, what's wrong with this kid? And I think he's about to blow away my thesis. That is the most ridiculous use of money management I have ever heard. What you have described is an incredible one-way bet. We should have 200% of the net worth of this trade, not 100. Do you know how often something like this comes along? Like once in 20 years. What is wrong with you? He said, so we started shorting the British pound that night. We didn't get the whole 15 billion done, but we got a lot of it. And there you go. And here's sterling Deutschmark. It collapses. And here's the net asset value of the quantum fund. It rises. So it takes a certain steel to do that. And I'm not saying any of you want to go and work for a macro hedge fund, but I was told tonight that Citadel is one of your sponsors alongside the Money Maze podcast. So they'll know all about that sort of behavior. Now, many of you who studied economics will know this. Those of you who haven't will, or maybe haven't heard of it, but purchasing power parity is the term we use to try and measure the value of a currency. McDonald's index is another one. And what we've got here is sterling dollar. And any of you who travel to the States, you know that today you go in, it's about $1.25 you get. But there were periods, such as before the great financial crisis, when it was $2.40. You see how far it is away from that red line? It was extremely overbought. And currencies are, for the most part, like elastic bands. You know, now they can break, particularly outside of the G10, but typically they're stretched to a point, like the yen today, which is the cheapest currency in the world, where everybody hates it. You know, but you only needed to get on a flight to New York to know it was for free. You know, you go there with your pound and your coffee wasn't the $10 it was today. You know, you were feeling quite rich. And so, of course, great financial crisis happens. Now, sterling Swiss franc, 1.1 sterling Swiss franc. So that's what you get today. Switzerland, don't go skiing in Switzerland. It's too expensive unless you're being taken. But 1969, okay? The only person who's going to win this is somebody who's within 1 franc. How many francs did you get for your pound in 1969? Shy Oxford students? I didn't think that was it. 1.1, exactly the same as that. What do you think happened to inflation? You got the other prize, didn't you? No. Oh, you haven't won a prize yet. Inflation over those periods, who's had the higher inflation? Okay, so there's a clue. It's a beautiful bottle of champagne. I will drink it, I promise you, unless I get somebody who's a... So, okay. 4. 20. 20, okay. That's proper depreciation. Okay, I want 3 more guesses, and then I'm going to have to...
It's great to guess.
9. Oh, getting warmer.
11.
Okay, it's 12. I did this at a school whose name will be remain silent, and I was doing it online, and bloody 5 people came back with the answer because they actually managed to Google it quicker than I could give the answer. So currencies are a source of pain and a source of, of pleasure. The oil price has these extraordinary gyrations. You know, we can think that the world is moving to an energy less fossil-intensive, universe, which it will do. But 85% of our energy needs are satisfied by oil. So to think that we can just turn off the pumps and, lie down in the middleways and say no more oil, well, you know what? Economies have to function. People have to have jobs. People have to get their data to heat their houses. You can see where I'm coming from. So oil is interesting. Now, that doesn't mean that wind, solar, you talked about uranium quite a bit, but I haven't got the slide here tonight, but that's part of the solution. But also, if you're thinking about preserving your wealth, there's always a conversation about gold. And, Will and myself have it because there are many people like great John Maynard Keynes who described it as a barbarous relic. But the fact is, all the gold ever mined in the world fits into 1.5 Olympic swimming pools. Okay? That's not a lot. And so when you want intrinsic value, the problem with the currency is that the money supplies typically are running 7-8%. There's 7 or 8% more dollars around in the world. There's only 1.5% more gold every year. So gold plays an important. Now, a few conclusions before we're going to change tack. Where there is reliable data, and this is Neil Ferguson, who's been on the show and written that brilliant book, Ascent of Money, stocks outperform bonds by a factor of 5 times over the 20th century. As an investor, earlier on I said you want to be a lender. an equity. You want to be an equity owner, not a lender. And the great Warren Buffett said, of course, cash combined with courage in a time of crisis is priceless. Because you know what? If you were sitting there at those periods when there was absolute trauma, I mean, of course, there's a possibility the world falls apart, but generally it doesn't. And then I thought I wanted to show you this chart because Argentina, of course, launched in 2016 a 100-year bond. And I mean, how many times has Argentina defaulted in its history? No?
8, 9 times.
No.
Is it 40 around?
No, it's 5. It's actually only 5. I mean, amazing, isn't it? You know, I think Greece might have defaulted more. But, you know, you've got to love Argentina. You probably love the Argentinians. But 100 years? I mean, why would you lend? And the reason that people did that is that the 10-year Treasury yield was 2.2%. And it's like, well, I can get 7.5. I mean, no-brainer. Now, it's true that for a while, the coupon compounded and you made good returns. In fact, what astonished me when I was doing some work is that at a similar time, Austria issued a 200-year bond with a lower coupon, and actually you made more money out of Argentina because that bond went down 75%. But look what happened to it. I mean, of course, Argentina, had to reschedule its debts, as it always does, and history does repeat itself, absolutely. And we haven't talked about active versus passive. The argument goes you have to be passively invested in the US. Okay, but China was really interesting because the MSCI, the Morgan Stanley Capital International, which does all the index compositions, changes the weightings periodically as countries get bigger. China, of course, became bigger and bigger, became 40% of the index, and then China collapses. So if you were a passive investor and you were following that mantra of needing to be close to benchmark or at benchmark, you would have made a huge switch to increase, and then you would have been taken out. Not relative to the index. So from a relative standpoint, you might have been all right. But as the adage goes, you can't eat relative. Okay? The problem is that we as investors want to be in the game. We want to have our purchasing power intact, and that's absolutely key. And so as I move towards the conclusion that I thought I was moving to a few minutes ago, this is what happens. We get invested. We're optimistic. We're excited. We're thrilled. We're euphoric. We're complacent. We get anxious. It's not happening. It's fear. It's then get the money, go, whatever, I must sell it down here. I'm bloody cross, because you told me to buy this, or why did I ever do that? And sure enough, depression gives way to hope, and new buyers come in, and losers move off. And we'll all make mistakes. Most successful fund managers say that if they can be right 53 to 55% of the time, that's good. But one of the great things, one of the things about the great money managers is they manage their losses really well. So they cut their losses. And it's one of the things that's most difficult because we become invested in something. We know that NVIDIA is leading the world of chips and AI. It's obvious, so of course we're going to own it until it isn't obvious and until something degrades and something changes, and then we all go, yeah. So Jesse Livermore, very ancient investor, said, lesson I learned early is there's nothing new on Wall Street, because there can't, because speculation is as old as the hills. Whatever happens in the stock market today has happened before, and it will happen again. So I think that seems like a great place to stop. Thank you so much. You've been a fantastic audience, and for coming as well. Thank you very much indeed.